For many founders of franchise systems, the goal is really to think about a big exit. When you're planning the big exit, you have to think about what are the drivers to valuations to franchise systems. Why do franchise systems compared to, say, independent businesses drive such a higher value in terms of multiples of earnings, multiples of royalties, which is essentially revenue, as opposed to the independently run business? And really it comes down to three major factors: rarity, time, and scalability. Rarity. There's just not that many of them. We did a study at the firm and we looked at how many franchise systems there are. There's varying estimates from as low as 3,000 up to as much as 5,000. And even of those active franchise systems, there's really only about 100 systems that are over 1,000 units and maybe 1,000 systems over 100 units. So you think about when you look at the size of the market and how many, billions of dollars, millions of employment, and everything that franchising touches. And it really comes down to just a few successful brands who've managed to get up to that higher level of franchising. So rare. There's just not many of them. So, basic economics, supply and demand. You have a lot of demand for these franchise systems, a very little supply. It's going to drive up price. And the other main driver, I think, is time, is that you can have all the money in the world and go in, private equity has plenty of capital, but you cannot create something in a short amount of time. It's like anything. It's like fine wine. It's good food. It's, building a championship sports team. It just takes time. It takes time to get everything working together and all the experience. The franchisor presumably had a business for many years, maybe even decades, worked out the bugs. What marketing? What's our value proposition? How do we actually get customers to want to do business with us? They figured that out in the local market and then they duplicated it. And when they first duplicated it, they had problems. Then they realized, wow, how do I translate this? How do I teach another business owner to do this business? And you look at any franchise system, there's a lot of scar tissue. There's a lot of challenges. There's a lot of reboots that they did throughout getting it right. And that just takes time. You tell people, we launch a lot of brands and people say, hey, how do I get to 50 units? It's not 10 a year, for 5 years. It's 2, 4, 8, 16. And it's this growth, that sort of exponential growth curve of franchising, which just takes time. You get your first open, it's going to take them a while to get open. Then they're going to have 1 or 2 years of financial history to prove out the economics. So, at a minimum, you're talking 5 to 7 years before you even figure out whether or not this business is working as a franchise system. So that time is something that private equity firms, buyers of these systems who want to really just get in, fix up a business and move on, they don't have that time. In fact, it takes as long to get a system knowing that it's going to work as it may do for the whole horizon of private equity. And the other one is scalability. We talk about that exponential growth. We talk about why that goes. The reason franchise systems are scalable is if you have figured it out in a couple of different cities, if you are able to go into a new city, learn the local market, take all your experience, your marketing, your training, your branding, your back-end system, economies of scale, knowing who the right franchisee is, all of that you figured out makes it scalable, because now it's rinse and repeat. So as much as we think for the franchisee, it's rinse and repeat, it's also for the franchisor. Now that takes a while. And not many people get there, right? Rarity, time, scalability, the three drivers of franchise valuations. And what do buyers of entire franchise systems look for? What they're looking for is transparency. They're looking for good unit economics at the unit level, and a business that can be scaled, a business that can be taken to the next level. A big part of that is compliance. Do you have all your franchise systems agreements in order? Do you have copies of all of your receipt pages? Can you say, when I sold this deal in Maryland, I know that I was registered in Maryland? So all of that comes back to it, where you're starting to think about compliance from the franchisee level. When we coach and teach a new franchisor that launches, and a lot of entrepreneurs are, hey, let me break it and I'll fix it later, but I want to move really fast. And that obviously is a great attribute for an entrepreneur. But as a founder, you got to take a step back. Early in my career as a franchise attorney, I would tell people, look, you got to make sure, and we still do this, but it's not the primary driver. Hey, you got to make sure everything's buttoned up. If you ever have a problem with that franchisee, we want to make sure the agreements are signed, the receipt pages, we've covered ourselves so that we can enforce our rights. And that's important. But if you're a well-run franchise system, 2 to 5%, you shouldn't have fights with your franchisees. You should sign up your franchise agreements. They should go in the vault. And that's it. And if they're paying their royalties and you're treating them properly, you're not pulling out the franchise agreement. However, when you finally go to harvest this business, if that is your goal, 5, 7, 10 years from now, and you go to private equity and you say, here's my 50 franchisees, here are all the franchise agreements, or my 200 franchisees, here are all the franchise agreements, here's their conditional assignments of lease, here's their spousal guarantee, here's all my receipt pages, here's my compliance. That's what they're looking at. So 100% of your franchise agreements will be looked at by someone who wants to acquire your system. And if they're not in order, you may know that person. Hey, I went to college with this guy. He's a great entrepreneur. We were partners in another business. He's never going to give me any grief. Sure, that's correct. That's your relationship as a founder. That's not going to be transferred. And the whole purpose of building a high-value business is its transferability. So when we think about the blocking and tackling of compliance, when we think about having receipt pages, having franchise agreements, having all of this stuff stitched together, what's in your agreement? Is your agreement written in such a way that the ultimate buyer, when we think about FDDs and franchise agreements, there are 3 audiences that we're thinking about. Obviously, the franchisee. Prospect. Who's going to buy this? Does it make sense? Is there a value proposition? Are we saying something in 2 paragraphs instead of 6? Is it telling a story here of what the brand is, the roles and responsibilities, creating, as least amount of ambiguity as possible? First audience. Second audience, state regulators. Look, at the end of the day, franchising is regulated. As you can see there on my map, those of you who are clients of the firm, you get your red states where every year we need to file something, let the state know we're selling franchises. The light blue, it's kind of one and done if you have a federal trademark, and then your federal states. And just understanding that there's a number of state regulators if you want to have a national brand, and your documents have to be written in such a way that they're going to understand and approve those documents. So that's another audience. The third audience, perhaps the most important audience, especially if you're watching, this clip, is planning for the big exit. Who's the private equity buyer? Who's the person that's going to come in and say, wow, this thing is buttoned up. They're going to look at they're going to look at the franchise agreement. They're going to look at the history of those FDD changes. Is it clean? Is it something they could leverage? Because they're now, once they buy the system, they're essentially buying those relationships, buying those contracts, and all the scars and dings and potential that goes along with that. So the FDD that was disclosed 4 years ago, those franchisees that signed, did you say it in a way that the buyer of your ultimate system, right? You're selling. You first sell your franchisees, you gobble that sort of up, it builds it up, and then you ultimately sell the entire system. Well, what does your FDD and franchise agreement, what does that structure look like? Is it written in a way that, are there things about territory and exclusivity? If you're going to sell to a platform brand, can it accommodate different, maybe even people who are adjacent or competitors? Have you thought that all the way through? So that's an approach that you really need to be thinking about, the 3 audiences for your FDD and your franchise agreement: the franchise prospects, the state regulators, and the ultimate buyer of your entire system. So why, what else are they looking for? They're looking for, a buyer of a franchise system is looking for, what makes them nervous: predictability, risk, and the unknowns. They're the 3 things that they're really, when they're doing their due diligence. Predictability. Hey, is there a predictability that these franchise agreements are going to be paid? They're going to pay their royalties. We did due diligence from a big private equity firm, a very, old school. It was a 40-year-old brand. It was, a lot of mom and pops. There was a lot of variances in terms of the agreements. There wasn't a lot of predictability about compliance. If they came in and said, hey, we want a new POS system, those agreements were so old, it was going to be hard to enforce that. So that kind of chills their thought on what that looks like. Predictability. How predictable is that cash flow going to be? And another piece of that is going to be the profitability of the franchisees. And that kind of goes in line with risk. How much risk is there that, post-transaction, these things are going to start to really fall apart? So you need to be doing due diligence on that. And the third is the unknowns. The worst thing you can do is go to market before you're prepared. What you should do is you should scrub your own system as if you're the buyer. And I've been involved with M&A for really my whole career, even, non-franchising M&A. And I used to always say that if I were listing a business or working with a business owner or a founder, I would say, be the buyer. Before you go to market, scrub the business and look at the business through fresh eyes, just like you should look at your business as a customer, right? I think about my founders as my clients, and I try to think about, well, how do I appear? How does my team appear? What are we doing to uphold, your expectations as the person who, I want to do business with? Well, the same thing. You get one shot at this in terms of selling your entire brand. Be that buyer. Think about the buyer. Look at your business through the lens of the buyer. And go through your agreements. Do a full deep due diligence. Build your deal room. If you have receipt pages, if you have issues, have answers. It's much better for you to find out those answers. And then you engage someone to sell the business. You go through, a investment banker type firm, depending on your size. And then you go through. And so when you finally have people in play who are legitimately interested in looking at your business, it's not a scramble. You've done the pre-due diligence. You have all of your franchise agreements in a deal room. You have a list of what these folks are going to ask for. You look professional. And what that does is it helps cramp down a little bit on the unknowns. Where there's smoke, there's fire. If you give them 80% of the information and they're really hammering to try to get the next 20%, you're like, well, I just don't have that. Give me another week. We're going to pull it together. What they're going to do is they're not going to think that you're lying necessarily, but there's going to be a certain level of mistrust in terms of the predictability of the information. They're going to think, well, if you're not that buttoned up, if you weren't really thinking about the franchise agreements and this was all just an afterthought, then you don't even know what those liabilities are sitting in your file. And it's really never the skill set of the founder to be the one who crosses every T and dots every I. That's why you're a founder. Run really fast, break a lot of things, go back and fix it, but take the hill. So you need to take a step back and you need to really analyze, what do we have here? What have we built? And where are the liabilities? Address those liabilities before you really have a buyer in mind. So do a pre-due diligence. And the other thing you really need to do, another challenge when you're selling a system, are franchisors who do not understand the unit economics of their franchisees. I would even say that the unit economics of the franchisees are probably more important to some level, or equally important, to the unit economics of the franchisor. Look, the franchising business is pretty straightforward. You have a brand, you charge a royalty, the royalty comes in, you have some cost to support that, franchise sales, operations, training. There's no magic to that. But at the unit level, that's what's going to really vary from franchisor to franchisor. How do your franchisees make money? Do they have high enough margins? Do they have the right IT in place? Do they have the right branding in place? Do they have the right systems in place? Is there an ecosystem where they actually benefit from being part of the system instead of the system just being a tax on them? Because basically your royalty is a tax on them. And are they getting more value out of that tax than they're not? And so there's some right number there, and you need to prove that out. The reason that matters so much, the unit economics of the franchisees, the reason that matters is because this goes back to the scalability. The buyer of your franchise system isn't just buying the cash flow. They wouldn't pay 10, 15, 20 times cash flow just to collect the same royalties that you've been collecting. They need to scale it. They want to take it, pour gasoline on that fire, and 2x, 3x, 10x it. So how are they going to do that? They're going to do that with happy franchisees who are making money. It's very unique in the business world how you have franchisees or buyers of franchise systems. They're not just looking at your business. If you buy a traditional M&A company, if you're buying a shipping company, well, there's customers, the customers pay for that service. That service has some competitive advantage. There's some moat. Maybe it's technology. Maybe it's licenses. Maybe it's government approvals or something that makes that business kind of unique. Technology, a whole bunch of things. Franchising is a little bit different, and so you have to have the mindset that it's a little different. What franchising is it's this ecosystem that you're selling. It's this thing that you can't just put your finger on it. There's franchise agreements and there's this royalty flow, but that royalty flow is coming from individuals who are there making money on the business. And so really it's their satisfaction that is driving the predictability and lowering the risk. If they're making money in their business, if they have some upside potential to continue to grow the business, if a franchisee, do you have a healthy resale program? If 7 to 10 years in, the franchisee wants to do something else, is there a market for that? Can that business get sold for a reasonable value and that business is supported? Is there SBA financing? All of these things pointing towards it's almost like when you sell your franchise system, you're making the ultimate multi-unit franchise. Think of the highest powered franchisee that you've ever sold, that you ever awarded a franchise to, that you interviewed, that you got to understand how good this business was. It's that on steroids. It's that times 100. It's so you really need to get into their head of how valuable this business is for the franchisees. These are that third party that's sitting out there that's ultimately going to drive your value. When you're thinking about the valuation of a franchisor, it's much more analogous to a software company than it is going to be analogous to, just a regular cash flowing business. And here's what I mean by that. It's a subscription model. You have a subscription model. From before that became all the rage and everybody wanted to be in the subscription business, franchising is the ultimate subscription model. You're going to teach someone your business, you're going to educate them on how you made money, and they're going to pay you a fee based on their success. And they're going to pay it every single week or every single month or however you do it. That's a subscription model. You teach them, you guide them, and you keep them focused. And as your system improves, a la subscription software, right? They come up with new software and everybody gets it. You're the franchisor, you come up with a new mousetrap, you come up with new ways, and everybody gets it. And they keep paying that subscription model. So that's why private equity, I go back, 20 years ago, people were paying 5-6 time multiples. It has exploded. And I think it exploded because buyers, financial people, the Wall Street people, private equity people, they have realized that essentially franchising is like an analog subscription model. It's an analog software. It's human beings who sign on to a paper system and pay a fee for everything that's happening. And that's why the value propositions for the value of a franchisor are very similar to the value propositions of software companies. Predictability, sustainability of cash flow, satisfaction, retention rate. All these things are basically, how many franchisees are you losing? How many are you signing up? Are people staying with the program for a long time? Those are all attributes of software. So when you're thinking about this, when you're thinking about what your job is as a franchisor, you are running a subscription model. And so the more value you give to your subscribers, i.e. your franchisees, the more value that you're going to have in your enterprise. And that's why it gets these kind of really, really large multiples. But your contracts, they're really important because that is the promise and the commitment of your franchisees to keep paying this subscription. And if you have a problem with them, can you enforce that agreement? And those are why it all sort of comes back in to the same piece. Franchisors are very valuable. And you're also starting to see in the market, buyers going lower and lower into the market because I think they're realizing that franchisors, once they get to a certain point, they become very valuable, and that growth curve is that. And so I actually am cautioning my franchisor clients who are still in the early stages. They get up to a certain point and then they start realizing how difficult it was. But it's not a linear business. So, you may be leaving, even though someone is thinking about writing a giant check to you, you may be leaving a lot of money on the table because the cost of going from home plate to first base is a lot riskier than going from first base to second base. And if you're somewhere between first and second base, It sounds great, but they want to take that all the way through to the home run. So you got to really be intentional about, I always tell people it's not maybe the best financial decision, could be the best emotional decision. You could be burned out, you could be sick of it, and listen, life's too short. That's a great reason. But if you still love the business, there are ways to scale the business, especially if you're past royalty break even. If your franchisor is generating enough cash flow to get the right professionals in place to take it to the next level, that's all the private equity firm is going to do. So you should really be cautious about selling too early. I think people either sell too early or sell too late. I think the timing of when you should sell should be, in addition to a financial calculation, it should be a personal calculation. Are you done with the business? Are you ready to do something else? Are you burned out? Are you not making the best decisions? Are you not the leader that's going to take the business to the next level? Those are all really, really good reasons to think about selling the business, and maybe a partial of the business, maybe stepping back a little bit. Good reasons. But from a financial standpoint, if you've gotten to the point that you're past royalty break even, and what do I mean by royalty break even? Your royalties, not your franchise fees, not the $40,000 when someone signs up to buy a new license. No, the royalties of the people that you have sold and you have opened. Are they generating enough cash flow? Are they bringing in, 30, 50, 80, 200 grand a month, 500 grand a month, that revenue hires a management team? If you've gotten to that point, that's when the value curve starts to really explode, because very few franchisors get there. There's 3 times to celebrate the life cycle of a franchisor. I think obviously when you launch, right? You've got your FDD, you're ready to go, you are officially legal and live as a franchisor. Number 2, you do your first deal. That's a big deal. You sell your first franchise, someone's written you a check for your knowledge. That's powerful stuff, exciting stuff. You should be very proud as a franchisor. And then the 3rd is royalty break even. When you get to the point that you have sold enough units that the royalties, not the franchise fees, but the royalties are enough to pay a team to support the existing franchisees you have in the field. You've now created a flywheel, because now you can keep adding to those folks, and theoretically, which is why franchisors are so valuable, theoretically, that flywheel can continue to grow and the cost is not going to be that big. I like to use the analogy of franchising as software. The first Uber driver cost a whole lot of money to field that Uber driver, the first public person that took an Uber ride, the first public person that bought something from Amazon. There was so much software and thought and cost that went behind that. The reason those companies are so valuable is because when they got to the 10th customer, to the 100th, to the 1000th, to the 10,000s, the incremental cost of the overhead was not growing as fast as the revenue coming in. So, it might take you to get to 10 franchisees. It might take you 20 franchisees. Don't obsess when you're an early stage franchisor about your own earnings. Spend that money. You are being judged by your royalty revenue, not your earnings when you're starting out. Yeah, if you're if you have 200, 300, 400 franchisees and you're generating, $20, $30 million, and that's a different game. I'm talking about the emerging brands. When you're a startup brand, put that money back into the business and make the business better. It's your royalty. You're valued on your royalties when you're a startup brand, not on your earnings. So pour that money back in to make it better. Keep making it better. Keep improving the system. And some people might get the royalty break even at 10 units, maybe 20 units, maybe 30 units. In fact, the longer you take to get the royalty break even, the potentially more valuable you are. And that is a little bit counterintuitive, right? It takes you longer to make earnings, but it's like anything, it's this time factor we keep talking about. The value proposition rises over time. The longer you have kind of this deferred gratification, this deferred profitability, the stronger the business is going to be, the stronger the business is going to be in the long term, because you've laid the foundation. It's your first. Franchising is a great business because at some level, it becomes easier to open future stores instead of harder. When you're a corporate, if you've run 5 or 6 corporate stores, the 6th store is harder than the 5th because your supply lines are longer, your infrastructure is getting bigger, your overhead's getting bigger, you need more layers of management. Your 10th is harder than your 9th. Your 15th is harder than your 14th in corporate stores. In franchising, theoretically, you can flip that. As you grow, you put in a process to open stores and they become independent on and of themselves. You're there to support them, but they're essentially independent businesses. So you're going to learn. Those first 10 are probably going to be really hard. Those of you who have that, and you learn something every time you opened, but your 11th is easier than your 10th. Your 15th is easier than your 14th. And that's why franchisors are so valuable. You get to 50 and wow, it's easier to continue to opening stores because we're getting better and better at this. We understand how to open stronger. Most franchisors, the unit sales at the units grow. If you're the 50th franchisee, you're probably going to get your sales growing faster than the 10th because the franchisor just kind of figured something out, which is why they're so valuable. So if you're a franchisor, you really need to focus on the unit economics of your franchisees, the speed that they're going to open, the best practices of what they need to follow, and that has to be proven out because the franchisor buyer, someone who's going to buy the entire system, is going to do a deep dive on what's happening at the franchisee level. At the franchisor level, those things are a little bit more of a known entity. The creativity and the uniqueness of your brand has to really manifest its stuff in what's happening at the unit level of the franchisee. That's what really creates a lot of value. And you're seeing franchisor buyers going sooner and sooner into the process, earlier and earlier into franchisors. They're paying less because it's more the potentiality as opposed to it actually being manifested. And so you should be aware of that. If you're a franchisor, you have probably gotten dozens of letters from people saying, we're looking at people in your industry. And yes, that's a compliment. It means you're on databases from the SBA or the state registrations. You're out there, you're advertising for franchises. And so some intern is scraping, but don't get carried away. My advice is be very intentional. When it is time to sell, be very intentional. When it is time for you to say emotionally, I'm ready to go. I want to bring in a partner. I want to move off. I want to sell the whole thing or a part of it. Don't just do it for the first person that, calls you on a date. You should be intentional. You should know what you have. You should do all of the pieces that I talk about, pre-due diligence on yourself, understanding really your value, and then going out there and getting multiple buyers to start looking at you so that you can get the highest value you possibly can. It has to be like anything, a very intentional process. And it could take anywhere from 6 months to 2 years to properly exit the business. So you also should be thinking about that emotionally, from an emotional standpoint. Hey, when do I see myself getting out? The longer you sort of take and the more intentional you are, the higher value that you're going to get, because you're going to be able to cast a larger net. You're going to be able to tell a better story, and then you're going to be able to really see that growth curve going. So, it's a big piece of why people franchise. A big reason why you should think about franchising your business is you're not looking for 2x or a 3x return. To me, if you want to be a franchise, if you want to build value and you just want to, double or triple your income, don't franchise. Go hire some corporate stores, build up a powerhouse regionally, and let someone else. The reason you franchise is for a 50 or 100x return. And to get to that 50, 100 or plus return, you really need to think about being a franchisor. That's your business. It's not just the fundamental business. The fundamental business, the roofer, the restaurant, the gym, the service business, the junk removal, the moving business, whatever that is, at some level, it's secondary. It's the most important part in terms of the economics, but your real business is being a franchisor and understanding how to be a good franchisor and following best practices, because you are going to be judged by your abilities as a franchisor and how you were able to create this system, this ecosystem of other business owners who took your knowledge of a consumer or business or whatever facing business and brought that into the business world to generate income, lifestyle, for all the reasons people want to be business owners in franchising. And franchising is very hot because people, they have the bug. They want to be independent business owners. So that is my advice, is to really think intentionally about your role as a franchisor, creating this positive feedback loop, having franchisees that are happy to be part of the business, that are making money, that support you, and you're adding value to the relationship. They're not begrudging paying you royalties, because that all is going to come up and it's going to affect your value. The most valuable franchisors are franchisors with happy, profitable franchisees that want to be part of the system, and it's growing at a nice steady pace. It's not growing too fast. You're not, selling franchises. You're awarding them to the right people. So if you get into a really good cadence, this goes back, there's not that many of you. Those who have really gotten into a good cadence, who understand the business. And if you get to that point, you're going to have plenty of buyers. And it's exciting.